Consumers are getting caught in a never-ending financial vice, squeezed by skyrocketing auto loan rates, almost non-existent zero financing offers, and an alarming rise in 84-month loans, all of which are making the dream of affording a new car slip further and further out of reach. Do you know someone in this situation? The data tells a grim story. Edmunds reports that Q3's average APR interest for new car loans hit 7.1%, marking the sixth straight quarter where rates have hovered around this suffocating high. If you're hoping for 0% financing deals, forget it. They barely accounted for 3% of new car sales and only for buyers with the most excellent credit scores. Meanwhile, desperate consumers are locking themselves into 7-year loans to stretch out payments, with 18% of new car buyers opting for 84-month terms in Q3, up from previous quarters. And here's the kicker: 84-month loans might seem like a way to make cars more affordable, but they're a financial time bomb. The more extended the loan, the higher chances of buyers being buried in negative equity. If you've ever done this, you know it's a vicious cycle. When the car depreciates faster than the loan is paid off, many drivers are left in debt that outlasts the car itself. Now, according to Consumer Reports, a car typically loses around 20% up to 30% of its value within the first year of ownership. But when consumers sign up for loans longer than 6 years, they're essentially guaranteeing that they will owe more on the car than it's worth for much of the loan's term. This can be catastrophic if an accident totals your car, or if you, the buyer, simply needs to sell it before the loan is paid off. And this issue is not just theoretical. Data from Experian reveals that negative equity has ballooned over the past 2 years. In 2023, nearly 32% of car buyers were rolling over an average of $5,300 in unpaid loan debt into their next car loan. That number continues to rise, and with interest rates refusing to budge significantly, the affordability crisis seems set to worsen. There was hope that recent Federal Reserve interest rate cuts might provide some relief, but industry experts aren't buying it. Some analysts are pessimistic that these tiny half-point cuts will lure enough buyers back into showrooms anytime soon. For perspective, while rates have ticked down slightly from pandemic highs, they are still double what they were in 2019. This, according to Bankrate. And unless the Fed initiates multiple substantial rate reductions over the next year, the reality is that any effect on the affordability of car loans will be minimal at best. As Edmunds' Jessica Caldwell puts it, Q3 was the same painful story. Car shoppers face relentlessly high interest rates and prices, which continue to choke new vehicle sales. The Fed's rate cut might help a little, but it's not the game changer that consumers need right now. And don't forget about the harsh reality of rising car payments. While experts say the average American household can reasonably afford $400 a month in payments, the share of buyers forking over $1,000 or more per month has surged above 17% for the sixth straight quarter. How much is your monthly payment? Now, according to Cox Automotive, this puts many households at risk of defaulting on their auto loans, as income levels have not kept pace with the cost of borrowing. Even worse, a report from TransUnion highlights that auto loan delinquency are at their highest levels since the Great Recession, with more than 3.5% of borrowers falling behind on payments. And I'm sorry to say, it's not just new car buyers feeling the financial pinch. The used car market has also been hit hard, with interest rates for used cars now averaging around 11.5%. Even buyers who opt for pre-owned vehicles are finding themselves locked into long-term loans. And with fewer incentives available, many are paying more than ever for cars that are several years old. Here's one. According to iSeeCars.com, prices for used cars have dropped 4.7% in 2024, but the lack of financing options means that the relief buyers were hoping for hasn't fully materialized. The Federal Reserve's recent moves may give the illusion of progress, but for the average car buyer, maybe like you, real financial relief seems far off. As car prices and loan rates continue to surge, the likelihood of the average American affording a new vehicle without falling into long-term debt is shrinking rapidly. The road ahead for both consumers and the auto industry appears fraught with obstacles, and without significant economic change, the pain is far from over. Here's the bottom line. The situation is dire. Car ownership is becoming a luxury that fewer Americans can afford. With loan terms getting longer and debt piling up faster than cars can depreciate, the future of the automotive market does look grim. If things don't change soon, both consumers and the industry are in for a painful ride. For what it's worth, you can see the lowest advertised prices in your city or town right now by visiting quotes.everymandriver.com. Use the drop-down menu. Select make, model, and your zip code to gain access to insider information on dealer pricing. If you don't like what you see in your area, expand that zip code. If you're willing to drive a few miles outside your area, you could save a few hundred, possibly a few $1,000s on a new or used car. Every bit helps. Quotes.everymandriver.com. There's also a direct link below this video. Thank you so much for watching. If you enjoyed this video, don't forget to like, subscribe, and hit that notification bell to stay updated with the latest insights from the automotive world. Hope to see you next time. Today's video is brought to you by The Cold Plunge. Use discount code DAVE150 at checkout at thecoldplunge.com. Immediately save $150 off your purchase. That's DAVE150 at thecoldplunge.com. There's also a link below this video.